Is the rally in bonds over? And if so, which type of bonds are most at risk? Mortgages, munis, high yield? Joining me to offer his view is Srini Prabhu, CIO of Angel Oak Capital. Srini, tell me, which bonds did best last year and which will do best in 2013?
Well, one of the best performing assets last year was non-agency mortgage-backed securities, which is where our fund focuses on. And we continue to believe that will be the case in 2013.
Well, your fund is up over 20% in the past year, outstanding performance. But do you think, especially with a performance like that there's trouble in the bond market? We keep hearing about a bond bubble deflating. What's your view?
There is a kind of a bond bubble which, whether it happens this year or in a few years, majority of the outperformance has already been executed in this marketplace. And that is more in the interest rate related markets, which is the agency mortgage bonds and the treasuries.
All right, let's talk about agencies and the housing market. We keep hearing that housing is doing better. What does that mean for the mortgage bond market?
Well, better housing, a better borrower is very good for the non-agency mortgage market, because that means the majority of the borrowers will be able to refinance their mortgages. Better home valuation means a lot of these bonds will have better appreciation, and that's good for non-agency mortgage-backed securities.
What about corporate bonds? Is there a sector you like? People love corporate bonds because they have all the cash.
Yep. The high-grade corporate bonds are in a better shape than, and even at the low yields as they are, they still are an attractive play. We tend to stay away from them as we find opportunities in other asset classes. High yield as an asset class is something that I would stay away from. I think it has achieved a lot of the outperformance, and when you have prices in the mid-hundreds, I feel that majority of the outperformance again has been executed out of the marketplace.
Well, when a high yield bond is only paying around 6 or 7%, that's not very high yield. So where can you find yield in this market?
I think there's better alternatives in non-agency RMBS, where you still get on a risk-adjusted basis 6 to 7% yields, and you're buying these bonds at discount around 85 cents on a dollar. The other place you can get good value is CLOs, which are substitutes for high yield bond market, and you're buying those and getting floating rate assets versus high yield being a fixed rate asset.
And do you have a view on foreign bonds? What about the emerging market bonds?
We don't play in the foreign bond market. Currency risk and a lot of the Europe risk, we don't understand how the fundamental value that's driven out of those marketplaces.
And what about govies, treasury bonds, especially with a big debt battle looming?
We are staying away from all government bonds because of the debt battle and the duration of these securities.
All right, and finally, we keep hearing about money going into equity funds. Is it coming out of bond funds, and what does this mean for your fund? And once again, that talk about a bond bubble.
Yep. I think a lot of the money will flow out of the bond, and it's probably flowing out of the bond from funds that are achieving 2 to 3% yields, which is majority of the fixed income universe. We tend to focus on 6 to 7% yields, and we feel like that's a good play for income-starved individuals and a good relative value play versus equities.
Thanks a lot.
Thank you.
And thank you for watching The Street.